the witnesses and the gentleman from Alabama.
Thank you, Mr. Chairman. Let me pick up on Mr. Yingling's analogy of the systemic risk regulator sitting up on Mount Olympus, surveying the scene. And what he said is, putting out the fires. Now, one of my problems is that he wouldn't put out all the fires. He would only put out the big fires, as I understand it. Is that correct, Ed?
That's correct, and more importantly, identifying the fires and then deciding who puts out the fires.
But, the little fires would be allowed to burn
to some degree, or the regulator on the smaller mountain would be in charge of.
Yeah, but to me, that's one of the really unfair aspects of too big to fail. It implies, and I've said this since September, it implies too small to save.
Correct.
And as we say in Alabama, that's just flat out unfair. And we seem to be endorsing with legislation and a regulatory approach like that. The other thing is that you have a regulatory agency sitting up there on Mount Olympus, and I agree. And they're not only putting out fires, but they're also repairing the structures at taxpayer expense. I mean, they go in and they are doing it with taxpayer dollars. And is that wrong? Or should we, as I said in my opening statement, let's try to agree on something going in, and that's that we don't have these multi-billion-dollar taxpayer bailouts. I'd ask all the panelists, what's your position on giving the regulator, and all we're basing that on right now is the Federal Reserve Act, some language in there, and but let me just start with you, Mr. Bartlett. Do you think that we ought to empower this?
Let me just announce that's a recess, so we have plenty of time. There won't be any votes. We can keep going. So that's just a recess.
Risk regulator to use billions of dollars worth of taxpayer money?
No, Congressman, I don't, other than what we now have, which is no analysis of systemic risk, no oversight of systemic risk, no one to notice systemic risk,
and let me
and the unlimited Federal Reserve dollars. So none of the systemic risk regulator proposals propose any additional authority on the solution problem. What we've proposed is the Federal Reserve as a systemic risk oversight, but then followed by a coherent, comprehensive resolution authority to resolve the failures in a coherent, consistent manner, which does not now exist.
And I would agree with that. Advance a resolution, but I think we ought to put a provision in there that they don't use taxpayer dollars. Another thing that I think, what do you think about advancing local lending more? In the past several years with the consolidation, we are getting further away from sort of Main Street lending. Is that a problem?
Congressman, I don't see it that way. I think lending is up. I think that the lending from all sizes of banks, both largest and smallest, is actually up. Regions in Birmingham and Compass BBVA in Birmingham and have in fact increased their lending. Whitney has increased their lending. So it's not size that either causes more commercial lending or less. It's the capital underneath the bank. So I don't see it as a size issue.
Of course, size is an issue when it comes to too big to fail, I guess.
We haven't seen, we're not ones that agree with too big to fail.
Okay.
Wachovia failed, WAMU failed, National City failed. The issue is whether we can identify and prevent the problems earlier, and then whether the failures or resolutions can be done in an orderly way.
And I'm on board with all that. Although I have to agree with Mr. Wallace, and I preface that by saying, could this be an incentive to take even more risk? I mean, when you have a perception out there that you have a government agency that's going to make sure that an institution doesn't fail, as he said, you identify them as systemically important. You're implying that there's some sort of guarantee. Now, even if you don't give it, we saw that in Fannie and Freddie. As soon as they began to fail, we all said there was an implicit guarantee. Mr. Wallison, is there any way, without just simply saying that that the government is not going to bail these companies out, I don't see any way to avoid at least an implicit guarantee, which I think we've learned is a bad thing.
Oh, I think you're correct, Mr. Bachus. The markets are very clear-eyed about this sort of thing, and where the government seems to be backing a company in some way and making sure that the company will not fail through government resources, then the market follows that lead, and they will make funds available to these companies that will be easier for these companies to raise and at lower rates than others they compete with. So we will have a Fannie and Freddie kind of situation developing in every market.
And I think the government can guarantee things, and that's Treasury bonds and debt obligations to the U.S. government, and that's where it ought to end. And if people think they're investing in something the government is going to back, they ought to invest in government bonds or securities or instruments.
Congressman Bachus,
Yes.
To go back to your fire analogy, I think really what we're looking at is whether we need a big, huge, large fire department, and I don't think that's what we're talking about here. I think we need to figure out ways to keep these fires from starting. If you look at the systemic risk of some of these largest institutions and the national dependence on those, I would question whether or not the failure of AIG and Bear Stearns, if they had been allowed to go down, what would the impact have been on Citicorp and Bank of America? I think that's really what we're talking about, is the interconnectedness of these huge financial institutions. They're too large and they can't fail, and if they do, everything else goes down with them. So we have to keep the fires from starting.
Sure, and that was his analogy. That was Mr. Yingling's analogy, but I appreciate that. And I agree with you. I think that's but once they start, I don't think the government ought to put them out at taxpayer expense. Unless we have guaranteed deposits, and that's where it ought to end. We ought to guarantee deposit, and whether that level's 250,000 or 500,000, it ought to end wherever that guarantee ends.
Thank you very much, Mr. Bachus. I'll take